Welcome to my channel and welcome to a new video. It's titled, Watch Out, the ECB is turbocharging inflation. What investors must know now. Are you interested in this topic? If so, I recommend reading Dr. Polite's Boom and Bust report. All information is available at boombustreport.com. And now let's get started with Watch Out, the ECB is turbocharging inflation. What investors must know now. On February 14, 2026, the Governing Council of the European Central Bank published a short press release. It has received little attention so far, but it is of enormous significance, and it confirms those who anticipate an increasingly inflationary euro. From now on, the ECB no longer wants to conduct monetary policy just for the euro area, but de facto for the entire world. Starting in July 2026, it will effectively offer newly created euros to all central banks worldwide that need euros through expanded repo operations. In doing so, the ECB is effectively declaring its willingness to further intensify the already high loss of purchasing power of the euro. Why and how? I will explain that now. To start with, you need to know that the ECB has long had so-called liquidity swap agreements with other central banks around the world and has also been willing to conduct so-called repos since June 2020. What are liquidity swap agreements? In liquidity swap agreements, central banks lend each other their respective currencies. For example, the US Federal Reserve lends US dollars to the ECB, and in return, the ECB lends euros to the Fed. At the same time, a week, a month later, the central banks repay the amount they received, which in the meantime they had lent to commercial banks or other financial market participants. The transaction amounts to money creation out of nothing, backed by money that was created out of nothing. It is fiat money supply expansion backed and made possible by fiat money supply expansion. The ECB's euro liquidity swap agreements date back to 2007, have been extended and redesigned several times since then, and were made permanent in 2013. What are repos? The term is the short form of repurchase agreement, meaning a sale combined with a later repurchase. The ECB temporarily buys debt securities, say overnight or for a week, from central banks or commercial banks against newly created euros. At the end of the term, the transaction is reversed. The banks repay the euro amount to the ECB and get the debt securities deposited as collateral back. The debt securities eligible for repos are euro government bonds and euro-denominated debt issued by supranational institutions, such as, say, the World Bank. What's new now is that the ECB will offer standing access to a broad set of central banks worldwide, essentially granted by default to all, unless excluded for reasons like money laundering, terrorist financing, or international sanctions. This makes the repo facility permanent and globally available, starting from the third quarter of 2026. Why does the ECB offer liquidity swaps and repos? They are intended to serve as a kind of insurance for financial markets. The ECB promises that it will provide newly created euros in case of, say, an emergency. This is supposed to prevent liquidity shortages and crises in capital markets in the first place, and to support the smooth transmission of euro area monetary policy. What may seem harmless and reasonable at first glance turns out to be highly problematic upon closer inspection. Because the negative consequences of liquidity swap agreements and repos are far-reaching, and here are some of them. With liquidity swaps and repos, the ECB's central bank money supply can be increased, usually to the financial benefit of the banking and financial industry. And it is inflationary. Economically speaking, an expansion of the money supply is inflationary, as it causes goods prices to be higher than they would be without the money supply expansion. Liquidity swaps and repos are also increase the commercial bank money supply if and when the additionally created central bank reserves are used by commercial banks for lending and thus commercial money creation. It is foreseeable that with the enhancement of the repo framework, the ECB will massively accelerate the inflation potential of the euro in times of financial crises. One reason is that the ability to get new money from the central bank virtually at any time, whether via liquidity swaps or repos, fuels the risk appetite of international investors, tempting them, for example, to carelessly grant loans to states and corporate borrowers at yields that do not cover the actual credit default risks. The ECB thus creates increased moral hazard, leading to price distortions and capital misallocation. One could even say that with its measures, the ECB is sowing the seeds of the crises that it promises to mitigate with measures that lead to crises. The apt comparison is a fire department that pours gasoline on the fire and claims it wants to extinguish the fire it itself started through issuing new money created out of thin air. And further, enhancing the ECB's repo framework increases the attractiveness of euro government debt for foreign central banks and investors, because euro government bonds can now be easily exchanged for euros at the ECB. What is more, the investor base for euro government debt will be artificially broadened if the ECB plan succeeds, strengthening the demand for euro government bonds from foreign investors. As a result, borrowing costs for euro area governments will be artificially reduced, encouraging politicians to take on even more public debt. Viewed from another perspective, foreign savers are lured even more strongly into investing their savings in euro government bonds than before to finance government mismanagement in the euro area. Furthermore, the expansion of repos should be seen as an attempt to extend the use of the euro beyond the current boundaries of the euro area, presumably to compete with the world reserve status of the US dollar. The ECB wants to ensure that easy access to euro liquidity increases global demand for the single currency. It should become more attractive for international banks and large corporations to settle transactions in euros rather than US dollars. So far, however, the euro still lags far behind the US dollar as an international transaction currency. Whether the ECB will succeed in making the euro more attractive with a now enlarged repo program is doubtful. The opposite seems more likely. Finally, here's a brief illustration of how repos actually affect the money supply. Suppose commercial banks outside the euro area, say in Denmark, obtain euros by issuing euro-denominated bonds on the capital market. Now the bonds mature, but the Danish commercial banks do not have euros and cannot obtain them in the market to repay the bond. They are on the brink of defaulting on their payment obligations. The Danish central bank cannot help the Danish commercial banks because it cannot produce euro itself. But if it holds euro government bonds in its reserve portfolio, the Danish central bank can obtain new euros from the ECB via a repo transaction and lend the euros to the domestic commercial banks. The financing gap of the Danish commercial banks is plugged. And so the Danish central bank has an incentive to demand euro government bonds to secure emergency access to euro money in this way. However, through the repo transaction, the ECB expands the euro central bank money supply, and when the bonds are repaid, it also increases the euro commercial bank money supply. The whole thing is therefore inflationary. The bill is paid by the people in the euro area whose purchasing power is reduced. And when the repo transaction is reversed, then the previously newly created euros are withdrawn again. However, one can expect that by then the market has calmed down and the euro area commercial banks are now willing to refinance the Danish banks' euro bonds, meaning the euro banks now obtain new euros from the ECB. The money supply rises again and the whole thing remains inflationary. Why now, one must ask, is the enhancement of ECB repos with foreign central banks happening? The answer is, euro government debt has become unsustainable, were it not for the artificial suppression of euro interest rates by the ECB. And the over-indebted euro area governments want to cover up the impending bankruptcy with even more debt for financing a war economy or other expenditures. With enhanced repo operations, the ECB may want to increase demand for euro government bonds by tapping foreign savings more strongly than ever before, circumventing a direct monetization of public debt. However, in a crisis scenario, in a situation where there is a sell-off in the bond market, the ECB will have to open the money floodgates more than ever before. Having said that, it may not yet be openly apparent, but the ECB has now turbocharged the inflation potential, and it is likely only a matter of time until the ECB's electronic euro printing press spins at ever greater speed, increasingly devaluing the euro's purchasing power. If you want to know how investors can and should proceed, read Dr. Polite's Boom and Bust report, written for investors who want not only to protect, but also to grow their capital in dangerous times. All information can be found at boombustreport.com. Thank you very much for your interest and your attention.